Hey guys, it's Maynard, it's Mike Bradley, and it's Tuesday, and we've got a heck of a show for you here today. I would characterize today's show as a real buffet of data, expertise, opinion, and controversial comments. I'm not sure if it's really going to be controversial, but I'm encouraging the team here to let it rip. So Mike and Colin Fenton will kick us off with some macro comments. Matt Portillo is going to jump in with his views of the last couple of weeks. Jordan McNiven is here. He's recently written a global gas report for TPH. And because it involves global gas, we got our good friend Alex Zaslavsky to come back and talk a little bit about the Russians, how they're going to be reacting to all these things. And then we're going to close with Matthew Blair and Catherine Webb. They've got some great new data on refining and on air travel that we think is really going to complete the picture. Okay, Mike Bradley, what do you think about the oil market? Too good? We'll do the Goldilocks thing. Is it just right? Is it too warm, too cold? Talk to us.
I'd say the global crude markets right now look just about right. Maybe a little bit overextended. I mean, if you look at where we were a month ago we were basically, the sentiment was very, very bearish on the commodity side. Crude obviously went $40 under. A lot of traders made money. This month, you had guys still a little bit short, and crude basically gained a lot of strength this month. A lot of people thought the June contract would go off negative as well. It didn't. Close today around $32. And the reason that is it's because physical demand is improving. It's probably improving a lot quicker than people thought. U.S. supply came off a lot harder than people thought. And global, OPEC cuts are now starting to kick in. And so here we are. I'd say right now you have two differing markets right now. You have a Brent market and a WTI market. And the reason WTI is doing so well at this point in time is Cushing is drawing. Last week you saw Cushing draw about 4 million. Today the APIs came out tonight. It was down about 5 million. We would expect that tomorrow in the DOEs. And so in 2 weeks you've had almost 10 million barrels pulled out of a Cushing storage. That's not going to be a problem. And so you've seen WTI went into a backwardation this week. No one would have thought that 30 days ago. And so what do we have right now? So what we have right now is some of these other grades, MEH, LLS, Midland, they're starting to get a little bit weaker. Spreads are coming a little bit down. And I think that's a combination of TI just being really strong, but also we're starting to see U.S. barrels curtailments are now starting to come back into the market. And so I just think near term that, at $32, we're probably going to go sideways for a little while, consolidate a little while, and we'll see where we are in a month. If we're sitting here a month from now, my guess is I'm not going to be talking about $22, $23, $24 oil, nor I'm going to be talking about $40 oil. We're going to be talking about probably low 30s, kind of where we are right now. And that's going to be a combination of three things. One, U.S. production's probably, the curtailments are going to probably come back a little quicker than we think, number one. Number two, demand's probably going to come back a little quicker than we think. And number three, OPEC plus cuts will be in full force. So a lot of things really offsetting each other. So I think this is a market where you're just going to kind of go sideways and before the next move into the fall.
And I asked you this earlier. You said the December 31 WTI price, the over-under is?
I think for me, the over-under is probably 40, but I think most people, the consensus expectation is probably more like 35 or 36 right now. So I'm a little bit more bullish simply because I think demand's going to come back stronger than people think it's going to come back. And I think OPEC cuts are going to hold on longer than people think. And I think what's going to happen is you're going to put a market in backwardation and we're going to drain global inventories. But that is really, really contingent on what demand does. If demand doesn't come through, then we're going to be wrong.
So you think of those three factors you listed, the one that's going to surprise to the downside or not be as good as people think is the amount of shut-in production we bring back.
Yeah, we're already seeing the curtailments. Like I said, you're looking at differentials right now in these basins, and they're starting to come in, which is telling you production is coming back in. That's a fact. And so the question is how much, and it really boils down to that's going to occur. The question is, are we going to have OPEC cuts and demand improvements really being able to offset that? And secondarily, what is going to be the reaction to the OPEC plus members when they see these barrels come back on the market? Are they going to start to cheat as well? We're not going to know that probably for another couple months.
Okay, so demand and longer term outlook, or any reactions you have, Colin, listening to all that?
Yeah, I mean, I think that's pretty straightforward and clearly what's happening. It's tough to envision two curves that are falling and then inflecting. So that's part of the issue here, and that's why you see some surprise in the market. For me, what is going to be one of the key drivers of the pace of that demand recovery is the states obviously reopening. And here, just in the last 24 hours, we finally had New Jersey and Massachusetts join the rest of the country in coming up with a reopening plan. As we look forward, it's pretty clear that people are pretty skeptical about jet fuel demand, and I know we're going to talk a little bit about that later in the call. But when we got the data last week, we really did have an awful number for jet fuel. It was the lowest since August of 1966 in terms of demand, but a pretty good number for gasoline. It's pretty clear that people are nervous about using mass transit. Insofar as they're allowed to go back to work, they're getting in their cars and doing so. When we look at the COVID statistics, there's also another dimension that I think is important to talk about, and that is you're seeing more and more data give us greater clarity on the dispersion of infection fatality by age cohort. And the reason why that's important is we've known the whole time that there's an age sensitivity to fatality of this disease, but the skew is coming in much more broad than had been anticipated. And to put a number on it, when we look at the Massachusetts data, and Massachusetts was the last state to open, the median age at death for a COVID patient in Massachusetts is 82 years old. Among that cohort, 98.4% had comorbidity. 61% plus died in a long-term care facility or nursing home, and we still have 65% of the local economy closed. So we understand why we had to take this response. It was a very aggressive response. But I think as more people get acclimated to the idea that resources will be diverted to long-term care facilities, nursing homes, and don't really need perhaps to go to schools and workplaces, I think we're going to get a more nuanced version here of what happens with demand. And that could tee us up for some surprises in jet fuel in particular.
So Colin, you used a Princeton word there, comorbidity. Make sure we understand that. You mean there's a second cause of death, or explain that one?
Yeah, so all that means is that the person may have had diabetes or cancer or influenza, pneumonia, had some other life-threatening disease in that age cohort. And look, we all care about our kids, our brothers, sisters, partners, etc. So whenever we see one of these stories come across the tape about children with the toxic syndrome or whatever it might be, it's human nature to hit the pause button and say, wait, what's going on there? But when you actually really dig into a number of these cases, what's clearly happening in many instances is this comorbidity effect. And what I thought was interesting in Colorado, and some of our colleagues, in this video are in Colorado right now, on Friday, that state decided to report two sets of death data. Those mortalities from the actual disease, COVID, and those who happened to have COVID when they passed away. Now, obviously, we want to minimize mortality as much as possible, but the fact that you're seeing states begin to behave this way means that they're beginning to understand with greater clarity and precision exactly what was the cause of death, as opposed to just assuming that it was COVID.
I mean, it's kind of refreshing, honestly, right? People are scrubbing the data and trying, if you're going to draw conclusions from data, let's make sure we're reading it correctly.
Big difference, too. I mean, it's 900 cases for the COVID specific and 1,200 for folks with COVID, just in the case of Colorado. And so when you begin to apply that across the entire economy, and you have in some industries unemployment rates north of 30 or 40%, there's a clear decision to be made here on economic activity.
And so, Colin, with this in mind, in a little bit of the pregame, we were bracketing some scenarios for global daily demand. One, if we stay down here so long, we really damage a lot of businesses. And the other is if people, to your point, start recognizing perhaps that it's safer than they think, how quickly we get recovery. I'm stealing your thunder, but will you give us some numbers on that?
Yeah, so right now we think that global demand for liquids is probably down about 14.5 million barrels per day. And you're probably maybe 500,000 barrels per day off that on the supply side. And clearly, when you see these flickers of backwardation at the front end of the TI curve, and we had cash prices in LLS reaching $30 last week, those are signs that the market is approaching balance. We also said last week that the average for the year would be 92 million barrels per day. We could get to 97 by the end of the year and maybe even see 100 by March. Now, obviously, there are downside scenarios which could be much different than that one. And I would actually argue that the equity markets, at least from where I sit, and I'm interested in hearing what the equity research analysts have as their views, looks a little expensive to me. It looks like it's gotten a bit ahead of itself. We had Open Table just in the past week predict that a quarter of the restaurants in its network could be in serious trouble, meaning extinction risk, that they're going to go bankrupt. And so it may very well be the case that demand is going to trip over itself. Mike used the term sideways, and I think that's right, and have a lot of ups and downs. And to expect it to be a straight line would be somewhat unrealistic. But hopefully, if we do find that the general public begins to understand that there is a concentration of risk by age and also by preconditions, then we can tailor whatever responses we have to those groups and then allow the other portions of the economy to recover more quickly than perhaps would have seemed reasonable to expect even a couple of weeks ago.
I heard a great quote in the last 10 days because someone was responding to this comment that, we should listen to the science. And the response was, what science? We don't know. We're learning as we go. And I think that's your point, Colin. When we start looking at this data, maybe we start making some choices and some changes. Okay, Matt Portillo, talk to us. I was going to get you to do the outrage of the week, but you said you didn't have an outrage of the week. What was on your mind this week?
Yeah, Maynard, I think investors are focused on a lot of the points that Mike and Colin brought up, which is where crude might be headed to near term. And there's three key things that we're watching in the next month that will likely cause a bit of a rate of change in terms of the inventory builds in the U.S. So first, we will be watching the shut-ins, and we do expect a pretty material amount of volumes to reverse in June. Just for some context, in May, we had our shut-ins pegged at about 1.75 million barrels a day. And we think about 1 million barrels will likely return in June, given the price signal in the market. Secondly, we are expecting an uptick in imports. That's really coming out of the Canadian market. Our Canadian brethren have followed the U.S. and have shut in quite a bit of production. In our estimate, it's been about 800,000 barrels a day of volume that's been taken offline. Again, the price signal in the market today would suggest that those volumes should come back on stream. And so that will start to filter into the data as we show up in June. And then lastly, exports. Exports are a key factor in the equation for the U.S. inventory trends. And exports have been very robust over the last month or two. We've been exporting about 3.3 to 3.5 million barrels a day of crude. Unfortunately, the rally in MEH and other crude grades in the U.S. has actually priced that ARB out to some degree. And so we are expecting a bit of a drop in export trends as we head into the June timeframe. All that really means is we're just going to have a little bit of a sideways trend, I think, as Mike mentioned, and potentially a little bit of downside risk to June. But ultimately, it is the healthy outcome of the market. We've seen crude rally to a point where we are actually able to bring production back on stream. And at the end of the day, that was going to be a necessary outcome. And so it's coming just a little bit faster than I think the market had expected. The last thing I'd say investors are focused on is activity levels. And we saw a huge frac holiday in Q2, really driven by the extremely low WTI collapse that we saw last month. We're getting back to levels where we could see activity pick up. I don't think we'll see much of a response in June. Be looking more for a July, August timeframe where we start to see frac spreads pick up. And that's going to allow some operators to start to stabilize some declines as we head into Q3 and really start to see a little bit of growth on a quarter-over-quarter basis going into Q4. So all in, the crude market's gotten to a point where the industry is off, life support, a little bit healthier here. And we do agree, you probably take a little bit of a breather given the rally in the price. And that probably means you take a breather on the stocks as well. Investor sentiment has cooled a bit. And I think a lot of investors we're talking to are just waiting to see how June plays out before making further decisions on investments in the sector.
So Matt, for the large institutional investor that does take a view that they would like to put some money to work in energy right now for whatever reason, what trend does it tend to follow? Does it go into large cap diversified? Does it go into infrastructure related things? Like if it comes in right now, where does it tend to land? I'm just sort of looking for the flavor of the week.
Yeah, I think we're seeing interest across the board. Generally, companies with good balance sheets, solid market caps that have sustainable dividends are still in favor. And so that lends itself to kind of the high quality, large cap midstream names, high quality, large cap upstream names. And then generally the integrateds is where we see a lot of investor focus at the moment. I'll let Matthew Blair comment maybe later on in terms of refiner sentiment and where that sits today. But generally speaking, I think investors are playing it through kind of a cautious but investable and structural long-term opportunity to get involved with high-quality names that generally have low leverage and pay out quite a bit of the free cash flow in the form of dividends and ultimately in the longer term, possibly in share buybacks.
Well, and Matt, I want to compliment you on your TPH Nation pullover this week.
Hey, Matt, just a question for me is what do you think the reaction would be? I mean, obviously a lot of companies talked out there about ducks, going back and completing ducks at the high 20s, low 30s. I mean, what's the reaction if today they went out and said we are doing that? What kind of reaction do you think comes from their investors or potential investors? Are guys saying, yeah, that makes sense, or are guys saying, no, that's just not the right thing to do? Guess what? You guys are dumb. You're doing the same thing you always did, and we're just going to avoid you. What's your thought process? What's the sentiment on that right now?
I think clients would probably like to see a little bit more clarity on the fundamentals truly improving before operators kind of dive back into bringing activity back to the field level, just because we've had such a huge amount of volatility over the last few months. And so I think caution and taking caution around adding back capital over the next few months and getting back to work on DUCs is probably the appropriate approach. And in general, I think the investors that we're talking to today would like to see a little bit more of a structural decline out of the U.S. just to continue to help progress crude fundamentals as we head into the back half of the year. So I think caution is warranted. At the end of the day, the DUCs that are being built will be blown down at some point. But I think a lot of clients that we're talking to would rather see that towards the end of the year rather than it be a phenomena in the Q3 timeframe.
Okay. Let's keep rolling. We're going to go next to Jordan McNiven. Jordan's a senior research member of our team based in Calgary. And he's recently, I'm going to hold it up for the camera here, he's written a global gas report. This is last week. And so, Jordan, we're excited to have you. And we've also got Alex Zaslavsky, who, as I mentioned, is from Horizon. He's a good friend of the firm. He was with us probably about a month ago, and we talked about Russia. But we thought we can't have a global gas conversation without having Alex as well. So, Jordan, what's the punchline on your report?
Yeah, I think in many ways, maybe the title of it is punchline. We called it the ball and chain. And we thought that was an appropriate title because what we're seeing in the gas market right now globally is that there's a lot more interplay between the U.S. and Europe than there has historically been, in large part because the U.S. has become a much larger player globally. But because of this, it's making it really difficult for pricing in either of those markets to materially dislocate from the other one. So to provide a little bit of context there, I mean, the global LNG trade is only about 50 BCF a day, so it's about half of the U.S. lower 48. And it's grown about 20% in the last 2 years. The U.S. being a big part of this, going from about 3.5 B to 10 over the last 2 years. So what this has done is it's created quite a short-term supply-demand imbalance, and that's only been made worse by the 19 pandemic. And so that's what we're seeing right now is we were expecting bad pricing in Europe. It's gotten materially worse because of the demand destruction, and that's starting to back up and impact the U.S. markets. And so due to the nature of U.S. projects primarily being tolling versus the rest of the world, which is primarily integrated, it makes the U.S. exports amongst the most flexible around the world. And, normally that's a good thing, but right now that's more of an Achilles heel. And so what's happening is the export arbs are negative right now, and importers are canceling their cargoes. And so those volumes are backing up in the U.S. and causing pricing weakness in the U.S. And so we're expecting about 30 cargo cancellations from U.S. facilities in June. We think this could get worse as we move through the summer. Utilization rates sit about 60% right now. We think they could slip down as low as 50. And even on these numbers, we still have the global market or the European market oversupplied by about 2 Bs a day. And so there will be, we'll need others to pitch in as well. And I'll be curious to hear what Alex has to say on this, because Russia is a big piece of this as well. But I mean, in many ways, to sum it up, it's kind of an ironic situation here where we've built out all the to pursue export markets and higher prices. But given what's going on in the global markets, it's actually quite the opposite right now. And U.S. pricing is actually being dragged down by weak global fundamentals.
Can I just ask you, Jordan, though, this does seem to be an irony of our gas production and our oil production, because the great news about it is you can very quickly turn it off. And so the bad news is that means it gets turned off quickly. But the good news is that's exactly the kind of asset you want to own, because you can turn it on and turn it off. How do you square that, or do you think that's an oversimplification?
No, I think that's true. And the flexibility from a U.S. perspective is the flexibility to turn on and off, but many of the cargoes are destination flexible as well, so they can chase the highest price at any given time and really create a lot more efficiency in the market. So it is a good thing. Unfortunately, it's probably not enough flex in the U.S. system to balance the global markets, and we will need help from some others. People are looking to Norway and to reduce their pipe flows into Europe, so taps off there. And then again, back to Russia, they come up in these conversations as well. A big supplier of gas, both pipe gas and LNG, into Europe and the global market more broadly. And people are wondering what their strategy will be, and if they will be willing to flex down their production, or if they're going to try to use this as a way to chase market share.
Is Jordan, overall, is this generally speaking a good trend that you're talking about? Is that the gas market is finally globalizing? Here you've got North America and Europe married. 5 years from now, Asia will join the family. Like, is this part of an overall good trend for gas that you're speaking to here?
Yeah, without a doubt. I think that we've seen a pretty rapid growth in the global space, and that's good from a lot of perspectives. It's good for gas demand. It's good on the emission side if we're displacing coal. It is a good thing. Now, the issue is the LNG market is actually in many ways like the kind of crude market of old, where it was driven by the mega project. And, we've got these chunky, long lead time supply projects, which aren't necessarily ratable at the same degree that demand is. And so it's quite easy to throw the market out of balance until it grows and becomes larger and more mature. But as I said at the start, it's only about a 50 B a day market right now. And so hopefully over time, as this market grows, the supply adds are less impactful and we get a smoother pricing scenario.
So Alex, it is great to have you on Vladimir Putin's whiteboard. I think Boris is his brother. On Vladimir Putin's whiteboard, what is he? If you wrote LNG up there, what would he fill it in? What's he thinking about? What are the Russians thinking about when it comes to LNG?
Well, Putin plays on a few teams here, because on the one side you have Gazprom, which is a Soviet behemoth, a legacy monopoly, which doesn't like LNG. It likes pipeline gas. It likes long-term contracts. It likes this kind of relationships that go back to the Soviet era. And it's a state-controlled company. And on the other side, you have Novatek, which is a private company, which quite conveniently is co-owned by one of Putin's old friends. And it's a very commercial company which has pursued one successful LNG project, Yamal LNG, and is now pursuing the second one. And is doing it quite well, quite competently. It has fairly low costs and actually will do well, even in today's environment. So for Putin, LNG is a source of pride in many ways, because that project Yamal LNG that I mentioned, it's probably the first project in the history of the world that didn't require even 1 cent of dollar financing. It was financed exclusively in euros and Chinese yuan, because it was sanctioned by the US. So for Putin, LNG for the moment means, we can still pull off huge projects even though the US might hate it.
So Alex, while we have you, there are these reports that, Putin has COVID. The U.S. election is coming. He just did the OPEC Plus deal. Maybe it hurt him. Maybe it didn't. they pulled the resolution that was going to make him, available to serve through 2036, whatever it was. What is the mood and temperature in the Kremlin right now?
Well, Putin is in a windowless bunker, so he is clearly quite concerned about the pandemic. His prime minister fell ill, but has since recovered. I think when it comes to the deal with OPEC Plus, the decision to break with OPEC Plus in the first place was a terrible mistake, very costly, and it was Putin's mistake. Now they're back. They made a deal. My personal opinion is that there will be widespread cheating as far as Russia is concerned. It's very difficult to verify output numbers in Russia because they are furnished by the Ministry of Energy, and it's very easy for the ministry to just cook these numbers. There will be also widespread incentives to cheat, especially in the parts of the smaller producers, kind of bottom up within the country. So I don't really believe that they'll cut 2 million barrels a day. And also in Russia, you don't cut output in proportion to your production. You cut it in proportion to your political power. So it's very difficult to imagine powerful figures around Putin agreeing to cut as much as the little guys. So the bottom line is that Putin is withdrawn a little bit. He's in a bunker, and the big boys around him do what they can to make money.
Do you know if he'll be supporting Mr. Trump this fall, or has he chosen a candidate yet for his support?
Well, I think on the whole he's happy with Trump because even though sanctions have been imposed, they have not delivered a big economic blow to Russia. The Russian companies and the Russian state have figured out ways to work around them. So on the whole, I think he wouldn't mind Trump being reelected. But the trick is not so much to support one side; it's just to disrupt and to show one's ability to do this with minimal resources. That's where he's done quite well, to deploy the weak hand that he has to achieve maximum.
I think we'd have to report he has a low finding cost on disruption. He did a good job last time. So, okay, we got a few minutes left. Matthew, you were going to give us some refining stats and things that you've been watching and thinking about.
Yeah, thanks, Maynard. So really, the one data point that stood out to us tremendously this week is Chinese teapot refinery utilization hit 74%. It might not sound like a high number, but to put it into context, a lot of times this figure is in the 50 to 60% range. A year ago, it was 61%. The 74% number is the highest ever, highest all time. And it really stands in big contrast to the U.S., where refinery utilization is pretty much near all-time lows. There's a couple factors driving the high refining runs in China. One is there's a domestic product floor that's helping to boost profitability. And then these refineries are also benefiting from cheap Middle East crude rolling through. Putting it all together, these teapot refineries are putting about 400,000 barrels a day of incremental product on the market compared to year-ago levels. And that's contributing to a Singapore 6321 crack that is now at negative levels. So both gasoline and distillate are extremely weak. The overall crack is at negative levels, and really hurting other refineries in Asia. Keep in mind too that China is now a net product exporter, which might come as a surprise to some people, but China's been a net exporter since 2015. So this incremental production definitely makes its way into the U.S. market, and eventually, refining is a connected market, so it could filter into the U.S. side as well.
Okay, Matthew, this is like comorbidity. Chinese teapot refinery. We think we know what you're talking about, but maybe just tell all our viewers what exactly you mean by that.
Sure. So the refining system in China is basically divided between the major state-owned enterprises and then the smaller independent teapot refineries. Teapot refineries generally aren't as competitive. They don't have access to the same crude. It's harder for them to place their products. And so a lot of times they run at pretty low utilization. China has embarked on a program to encourage these refineries to become more modern, more complex. And as a result, the long-term trend is for higher utilization.
but to see all-time record teapot utilization at a time when refining is so challenged, it just really stood out to us.
Is there any data or implication from this refinery utilization that the Chinese are driving more, that there's a demand pull? Is there anything positive to pull from it like that?
Yeah, so that's a good question. So we track TomTom global congestion data, and in our 25 city set globally, 6 cities are in China. So 6 of the 25 largest cities are in China. And one of these cities is actually back to back to year ago rush hour congestion levels. The other 5 cities, they're not quite there yet, but they're definitely better than pretty much anywhere else in the world, India, US, Europe. So yes, there is evidence that China is much further along in its recovery than other countries. I think that probably makes sense to a lot of people, just considering China was hit earliest. But yes, there is evidence that they are progressing and returning back to normal. I don't think they're quite there yet, but they are getting back there.
Awesome. Catherine, I think we're going to close with you. You've been digging up some air travel stats that you were going to share with all of us.
Yeah, great, thanks. So as Colin alluded to earlier, jet demand has obviously fallen off a cliff since COVID took place. We track some weekly indicators just to kind of get a sense of where we're at in the cycle here. So one of those is weekly scheduled flights regionally around the globe. Last week, that number hit 273,000, which is up for 2 consecutive weeks from a low point at the beginning of May. We're seeing particular strength in areas that have reopened, which this week included India and Singapore. And we also had a couple of positive data points from Korea, the US, and Japan. The US data point was particularly notable because it's the first time since the pandemic broke out that we saw a week-over-week increase. China actually fell slightly week over week, which is a bit surprising, but I think the more important piece to pay attention to is that China's scheduled flights are only down 29% now versus 46% at the beginning of April. So we've definitely seen some recovery there. A couple other quick data points we track from Flight Radar 24 and the TSA. The Flight Radar 24 data shows 7-day average global flights were up 8.5% this week. And the TSA data showed that the number of passengers moving through checkpoints was up 23% this week. So all in all, we're definitely seeing improvement in this data. We're a long way from 2019 levels, and I'm sure we won't get back to there by the end of this year, but I definitely think we have seen the bottom at this point.
Well, look, thanks everybody. I thought it was fantastic. A lot of good data, a lot of interesting observations. It feels like we could call this show neutral to up, something like that. So I'm hearing some good things, but we do all need to be cautious. All of you be cautious, but we're feeling some upside here. And thanks everybody. We'll talk to you next week.